Hey everybody, welcome to Stock Trading Pro. My name is Pete Renzulli. Let's get to it. There's going to be plenty of volatility this week. There's not even a question. Obviously, we're going to start out today talking about Meta platforms and their potential move coming off of earnings that's lining up. If you've been watching the stock has been beat up pretty good this year. As a matter of fact, a lot bigger than a lot of the other large cap stocks. We're also going to talk about some growth stocks and whether or not those large cap stocks are even considered growth stocks. I think that they're pretty much in the mature stage at this point. But here's the big thing. Last week, we had a couple of interesting things happen where financial stocks and growth stocks, or I should say technology stocks, caught a bid together. And when those two groups of stocks are trading well, the market is a really, really fun place to be a buyer. We caught that bid last week. Something else happened that we talked about probably around a week and a half ago with something known as accumulation. Now, you're seeing a lot of headlines, both on YouTube and probably everywhere else that you're reading right now, about how much the market's going to crash, how much the stock market's going to go down over the next 3 to 6 months based on inflation. We also have GDP data we're going to talk about today coming up. But here's the thing. Let's just be straight up about this. We're all friends, right? We're on YouTube. We're having a good time about this. Absolutely nobody can predict the future. Let's just be clear about that. Our job when we open up a trading account is to take a look at the market, take a look at individual stocks, and build arguments for what is most likely going to happen next. So when we talk about probability versus predicting, we are in the probability game. Every single thing that we do is we are building arguments based on order flow. And the second part of that is reading the tape, which is that order flow still valid in the time that I plan to place the trade? And actually, let me fix I feel like I'm looking off to the side there. So anyway, the big thing that we're looking at is we had two big accumulation days in the last 2 weeks, which is a start. Accumulation days in the SPY, we'll take a look at the SPY in a second, are when we get these big volume increases and big percentage gains. Now, we said, if you remember, probably about a week and a half ago, there's 4 stages of price action. One of those is accumulation after a big move to the downside. Now, it usually takes anywhere from 5 to 7 accumulation days over a month, over 4 to 6 weeks to say, okay, big money is stepping in and something interesting is going on right now. Now, until it finally bottoms out and we start to get out of this big move to the downside, those are mostly going to be short covering, looking for short covering to lead to new buying. So we're not out of the woods yet, but I want to be very clear about this. It's interesting how it's unfolding that way. Second part that I want to talk about right now, you really need to decide what type of trades or investments you're making right now, because there's a really big mix between the bigger picture headwinds of the macroeconomic picture, which I know that's fancy terms, right? It really means inflation, still not pretty. And you put all those pieces into the equation, there's a lot of stuff going on behind the scenes with the Fed, how exports are being affected by everything we have going on right now, which is why I'm looking at the chip stocks right now, the semiconductors on the downside. We're going to talk about Tesla in a second as well. But let's jump right into Meta, and I'm going to break it down in a little bit different way today than maybe we normally do. So just stick around for 2 seconds. I'll be right back. Okay, so first of all, thank you so much for joining me here. I really, really appreciate it. If we do a good job, please do me a favor. Make sure you hit that subscribe button, hit the like button. At the end, let me prove that I have a good episode for you today. If we do, hit that button. So we want to focus a little bit on Meta right now and Meta stock. And if we go out and do a little bit more of a long-term view of the stock, we're actually now pulling into some pretty big long-term support levels. You can see this is actually where we rallied in 2017, found support in 2019, pulled back during the big world crisis over here, and now we're resting right at this level again. If we zoom out a little bit further, you can see how significant these levels are, right? Didn't quite get down there in 2020, but we're resting right at a big level. Now, the big thing with earnings season right now, right? As we talk about with every earnings season, is expectations. This is the big thing. Expectations are what moves stocks after earnings. We get this question all the time, and it's a really good question, but it's not the actual raw numbers that are going to make a stock move up and down after earnings. It comes down to what was expected. So even if we take Tesla, which we're going to take a look at Tesla in a second, It was the expectations of what they announced, and all of the analysts and put together the numbers. It's not the raw numbers. If they could still produce record numbers and the stock can still go down if it just meets or barely beats expectation. Remember, we are paying for future cash flows based on the expectations and what's expected to continue happening. Not last quarter. We already, if you owned it, that was last quarter. That was fine. That was the number you just got reported on, right? But now going forward. So I'm going to break this down a little bit different. I don't know if anybody here has ever gone to the website called New Constructs. It's actually a friend of mine, David Trainer. So we're actually going to break it down, and we're going to look at this a little bit deeper. We're going to take a look at Meta. And remember, I keep using the terminology cash flow. Free cash flow. If you've ever run a business, so look, you're probably running your own personal business, right? Your household income, you have your income, you have your expenses, and what's left over. The free cash flow is what companies have a chance to invest in. You know, there's two ways that companies pay that money to investors: capital appreciation, or they pay dividends, right? So you get dividends or capital appreciation. Now here's the big thing, and this is why I want to talk a little bit about Meta today and why it's interesting, especially at these levels, especially with the expectations, is there's a third part of it that really doesn't get discussed enough. And this is a really big part of what Warren Buffett does. And not saying I'm even in the same universe as Warren Buffett, but there are clues that Warren Buffett puts out there, is they look for companies that have cash flow and are good at reinvesting that cash flow. And a lot of people know that as return on invested capital. So when companies, especially mature companies, get to the point where their R&D can't figure out new things to do with that cash flow, they'll pay it out in dividends, right? So the thing with growth companies specifically is they take their profits, they take their free cash flow, and to keep growing as a growth company or as a fast growing company, they reinvest that money in ways that are higher than the cost of capital. So whatever that cost of capital is, if they could reinvest that in either acquisitions or buying their stock back, if it's higher than the cost of that capital, it's a profitable return on invested capital. Now, the thing with Meta, I almost said Facebook, the thing with Meta right now is they have a ton of cash flow from their advertising business, and they're reinvesting that in the metaverse. That's why they redid the entire thing. So they're trying to take that money, all of that cash flow, like Warren Buffett does with the insurance companies. They take all that cash flow from the insurance companies and they put that into new investments. So they're constantly taking new money and putting it into new investments that are higher than the weighted average cost of capital. That's the big thing. So I'm going to show you, we're going to walk through Meta and basically build the argument for why I think the cash flows, at least in the short term, combined with the lowered expectation, combined with the support level that we're at right now, there's a pretty good chance the next quarter, so from this week's announcement, which I believe is on the 26th, 2 days from now on Wednesday, and this quarter going out, there's a pretty good chance that I believe, again, everything we do here is for educational purposes, but there's a very good risk reward trade setting up. So we have this massive support when we're taking a look at where we are in the charts. Now, we get this question all the time. How do you clearly define support or resistance? You can clearly see right around this level, there's a lot of activity, right? So when you're looking at stock charts, when you're doing technical analysis, and specifically right now, we're looking at Meta stock analysis, right? Keep support and resistance simple. Where is the last place buyers did something significant? That's the value area. Where is the last place that sellers did something significant? That's where they say the value is gone, and now we're going to start pulling back on the shares that we have. There's no other way to look at it, and quite frankly, keep it that simple. The easier it is for you to make a decision because you recognize something significant, the easier it's going to be for you to say, I'm going to make this trade with confidence because I have a good argument for why I think what's going to happen next. Not because we're predicting, but because the probabilities are stacked in our favor. Now, normally what we do is order flow stacking. We take the market, we take buying or selling pressure over time, we take sectors, and we take industry groups. And by the way, I'm going to walk you through 3 industry groups that are really interesting to me right now that we're going to watch over the next month as well. We're going to talk about that in a minute. So when we get into the deeper part of Meta, and we're taking a look at the technical picture of Meta, And then we combine that with the expectations for the current earnings season, which have been lower. Now, remember, if you are a history of earnings season, Steve Jobs was probably the guru of earnings season, where every single earnings quarter, it seemed, we're not going to meet our numbers. And every single time he would convince the analysts to lower the guidance, they'd beat that lower guidance and the stock would rocket higher and he'd look like a genius. Good for Steve Jobs, right? It's a very common playbook in Wall Street. So Meta's not actually lowering their guidance themselves. They're not actually doing it themselves. The market has kind of priced it in. It's gotten beat up pretty good this year. But now here's the thing. The expectations are ridiculously low. So with low expectations, all of that cash flow and a big technical support, I really believe right now that Meta is at a spot where the downside is manageable because we're at that big support level where buyers kept stepping in over the last 5 to 7 years, and we have these lowered expectations. When we combine that with, now let's move on back over to new constructs. We're going to take a look at Meta and the way they do things. What's kind of cool about what they do is there's really only very certain things that they're looking at for valuation. So if we bring it over first and we take a look at the risk reward, very attractive. Now you're going to see as we move across, very attractive is based on all of these, but more specifically, the two that I'm looking at the most is, and let's actually talk about this here, reported earnings per share versus economic earnings per share. The way that David Traynor does this in New Constructs, it's a little bit different. Economic earnings represents the true earnings for shareholders, 30 different adjustments, which is very different from the numbers that are reported that you hear they first come out and everybody's looking at that. So first we're going to take a look at economic versus reported. Positive economic earnings. Now let's keep moving over to the side. Return on invested capital. Remember what we just talked about. Companies can give their shareholders that extra money if they do not have better ways to invest that capital over and above what's known as WACC, weighted average cost of capital, right? So return on invested capital measures how much profit a company generates for every dollar invested in it over its lifetime. It's in the top quintile. It's in the top of return on invested capital. So think about what Mark Zuckerberg and Meta is doing right now. They changed their name because they have all this extra cash flow and they could put that money into R&D. Now, whether or not you believe the metaverse is the future, doesn't really make a difference at this exact particular moment. That's a whole other industry that's being born. We're talking about now the company and how they reinvest that capital. They are in the top percentage of how they reinvest their capital. That's very important. All right. So we're going to work our way across now. Free cash flow yield. Let's take a look at that. Measures the amount of cash available for distribution to all stakeholders relative to the total value of the enterprise. So they're also near the top in that. Work our way over. Price to economic book value, also in the top percentage. And then market implied growth appreciation period. Now, this is really interesting. What this actually says, let me actually walk you through this because this is super, super interesting. Something that a lot of people, I guess, take for granted is the stock market, the very price of the stock that we are looking at implies the growth appreciation period for the stock to be at with how much it can earn on that return on invested capital and whatnot. So basically what we're looking at is what is the current price of the stock telling us how long it will take to justify the price it's currently at. So you look at a lot of stocks, like we could use Tesla, for example, where I think the PE right now is around 80, where the PE of the S&P 500 is 16. So it's saying that it's a very big going forward, right? So what they're telling you here in this right here is it's saying it's less than 3 years to justify the price that we're currently looking at in Meta. There are some other stocks, we won't necessarily take a look at them right now, but there are some other stocks where the growth appreciation period will take much longer to justify the current price. So when you combine all of this, the growth appreciation period is good. They're saying the price that it's at right now, to justify the current price, it's not going to take too much for the stock to move to justify that. That's awesome. We also have free cash flow yield. Awesome. We also have this massive technical support. Awesome. So there is a very big reason to pay attention to Meta's earning this week and how the market reacts. Now, here's the big part of the trade, right? We just put all these pieces together, and that's a big part of what we do. The more pieces you can put into that argument, the more conviction. We get this question a lot on our coaching calls, is how do I have more conviction in my trades? And you think about it, sometimes you put a trade or an investment on, it moves in your favor, and then it kind of dances around. And that little dance around is like, I got to get out of this, I'm afraid. Conviction in the trade comes from building the arguments for the idea. So even if we just use just what we're talking about right now for this argument for Meta, we're talking about the expectations are ridiculously low. So they have to beat those lowered expectations. We're talking about this massive support level that's going back all the way back to, let's say, 2017. We're also talking about what we're seeing here in new constructs, risk reward rating, very attractive. And when he's talking about very attractive, he's not even talking about the technical picture that we're talking about. This is just the raw data. David Trainer's company is amazing when it comes to this stuff. Positive economic earnings, top quintile of return on invested capital, which is all of that earnings revenue from from advertising. Free cash flow yield is good. Price to economic book value is fantastic. And this is probably this is really what we're investing in. Everybody's heard of intrinsic value, that kind of thing. Everybody knows margin of safety from Benjamin Graham. I'm not saying that it's at a price that's a margin of safety, but what we are seeing over here is it's basically telling us that the current price and how long it will take to justify that price is very short, which means that it's priced right now, not overpriced. That's really the point. It's not overpriced, not quite at a margin of safety, not quite below intrinsic value, but it's super interesting at this price where it's no longer overvalued like a lot of stocks were over the last, let's say, 18 months. Now, a lot of stocks have pulled back, but not a lot of stocks have pulled back that much where it makes a big difference. Maybe we could even take a look at, we won't do that now. We'll break it into, we'll dive a little bit deeper into what we're taking a look at right now. So investment recommendation summary on Meta right now. Risk reward assessment, superior upside potential. And that's when the stock was a little bit higher than it was right now. 23% of companies will have fewer earnings adjustments. So basically that means that their earnings adjustments are in line. 10% of companies have fewer valuation adjustments. So now let's go down a little bit deeper into the ratings history. Look at where the stock is now at the same time where this stock has taken off in the past. And now you could actually see where we break this down even further. Book value, EBITDA, enterprise value. Look at this, 10. Right now, trailing 12 months PE is 10. That's why when we're looking at this article right now, people are saying this is a steal. This combination of building the argument. Remember, just one reason to put on a trade, you're not going to have conviction. It's in the alert, and it went up a lot yesterday. So, for example, if we take a look at the sector rotation heading into today, it'd be very easy to be like, wow, look at how strong everything is. Everything flew. We're going to get involved in all those stocks, right? That's a weak argument. That's only one argument. In this case right now for Meta, we're talking about this massive support level that buyers keep stepping back in. We're talking right now about lowered expectations and the idea of all of that free cash flow at the current price, making it an attractive, let's just say, investment at this point. And what we're talking about right now, let's just keep it in mind. We're probably just talking between earnings right now. We're talking about from one earnings report to the next. We're not going to go out further than that for this particular call. So what I'm talking about is you put all those pieces together and you're like, why should I choose to accept risk? You want to write that down. It's a very important part of why we do everything here on Stock Trading Pro, and hopefully you're doing the same thing. Why should I accept risk? And you put this reason and this reason and this reason. You put one reason, that's not really a strong foundation to lean on to say, yeah, I feel really good about accepting that risk. But when you start to put in 2, 3, 4, 5, 6, 7 different reasons why it's a good idea, and you believe that you have good risk to reward based on all those reasons, that's when you start to find some good ideas where you should have conviction in putting the idea on. Now, here's the thing. We have that support level, and I want to map out the entire thing, right? We're basically talking right around 120 to 125 in that area, right? The reason we choose to accept risk is because if we put that investment on it, we put that trade on, and we're like, okay, I'm willing to risk X amount of dollars for this idea. If the idea works out because of that argument that I built for all the reasons that we just covered in Meta, then we feel like it's okay. If I put up $1,000 and I could make 10,000 off of this idea, if the argument follows through in the direction, cool, I'll take it, right? If we put up that $1,000 and we have all of those reasons for doing that, and if it does not follow through, meaning it goes down, again, everything we do is probability. There's no forecasting. Get forecasting out of your head. If it does not follow through, we're okay with that too, because we're said, okay, based on this argument, based on every reason we have for looking at this idea right now, in this case, Meta stock, if it follows through, we're good. If it doesn't follow through, we're also good, because we're accepting the risk, we're accepting the dollar amount based on the likelihood of the idea moving in the direction that we believe. Now, that second part is a part where a lot of traders, a lot of investors get absolutely hammered, where they don't look at the other side of the trade. The way that we do things, the way that I teach, is you are running a money management business. Everybody here, everybody watching this video replay, you are running a money management business, and any business has expenses. The craziness that we have, where we think that we're never going to have a losing trade and we get upset when some trades don't work out, is just not real. It's not in the real world of running any business. So the way that we do things, the way that I teach everybody from day one when we're working together, is a trading loss is a business expense. It's the cost of accepting risk in exchange for making money with your business. So remember that. You need to map out both sides of the trade. You need to come up with a trading game plan that says, here's all the reasons why I like this idea. And if it works in my favor, cool, I'm going to accept risk. And if it moves in my favor, fantastic, I built that argument. The other side of the trade is if it moves against me, I'm also not happy about it, but I'm okay with it for running a business because I accepted the risk, I accepted the dollar amount, and if it moves against me, I'm out of the trade because it was a business expense, and then I'll just look for the next idea to make that money back. That's what will separate you from everybody else who says trading doesn't work from I'm running a business, because you're accepting the fact that you have to spend money to make money. And sometimes it's computer software and sometimes it's a loss on trading. All of those expenses are what we do in exchange for making the upside of a trade when it works out. All right. I want to hop on over to take a look at Tesla, because Tesla is obviously a very big company that everybody watches, down 3% pre-market after now they're talking about price cuts. Let me tell you something, as an entrepreneur, margins are everything. Elon Musk has such a first mover advantage in a gigantic way. He's also got Twitter going on. Margins in a company will dramatically change when people don't want to pay $70,000 anymore for a Tesla, when they can get basically an identical car, a very similar car, for half of that. He didn't have massive competition at all. Now it's starting to seep in where there's a lot more companies doing the same thing. Obviously same thing when Henry Ford had his stuff out there. There were hundreds and hundreds and hundreds of companies. A few of them end up lasting, right? Look, I think Elon Musk is a genius, but the reality is that competition is coming in a much bigger way right now, and it's going to cut the margins. They have a huge first mover advantage. I'm not saying anybody's going to take over Tesla. What I am saying is the business economics are changing as more people start to put out better and better cars. I don't think anybody's going to come close to taking them over. They have such a big advantage, and they have him, quite honestly. They have him as the genius behind everything, and how much he stays in the media. But let's talk about risk reward, building the argument if you happen to be a long-term investor in Tesla, or if you're basically just looking for some short-term trades to take advantage of the volatility. You can see here, again, this 208, 206 to 208. Let me actually bring this over on the daily chart, probably a little bit easier to see. You can see that we keep dancing right around this level. We're actually right there again. 206 to 208 is the level. If we break that level, we're now looking at 180 to 183, which is roughly a $30 to $35 move to the downside. If Tesla continues to have these negative headlines, that is the next level. And as it pushes down to that next level, that's where we're going to start looking to start reassessing whether or not, again, very similar to what we're talking about in what we just looked at in the data for Meta, we would do the same exact thing. Let me actually see if I could pull that one up on Tesla. We'll take a look. Yeah, actually, let me pull that up. Let's actually take a deep dive into that right now. And we'll just give you an idea on the math of the way that Tesla looked compared to what we just looked at Meta, just to give you some ideas. So New Constructs actually has this listed right now as a strong miss, and that's at the current numbers, neutral at best. So again, they're putting out based on the numbers, and you can see it's not all across the board on the top, right? Good economic reporting, good return on invested capital, free cash flow yield, negative. Big difference. Price to economic book value at the bottom, and this is probably the biggest one right here, is remember, growth applied appreciation period. This is telling us how long it's going to take to justify the price based on the book value. So there's a very, very different argument at this particular moment in Tesla. I love Elon Musk. I think he's a genius. He's done it more than once. How do you not love somebody who's done it more than once, going all the way back to his PayPal days, his rocket ship? I mean, how many people do these kind of things, right? He's a genius. We're not talking about Elon Musk. We're talking about the math of the company and competition and what you're paying today for those future cash flows. That's the thing to really think about. So if we go back to building an argument for the idea, is the idea on solid footing right now based on the raw numbers of what the market is telling us, how long it would take to get to justify the current price? Remember, that's what we're buying. We're buying the market's implied expectation right now of the current price and how long it will take to justify that price. Now, a lot of people, let's take PLTR stock, for example, Palantir, were fascinated with the CEO of that company. And you can see the market is pricing in the reality of what the stock does. The stock needs to change its math in order for this to no longer be kind of languishing down here under $10. Remember, it's really pure math. It comes down to competitive advantage and then what kind of earnings, more importantly, margins is that company going to yield. And then those margins are obviously amplified based on the cash flow that the company throws off. So right now, there's a big difference in picture at this moment of Meta stock versus Tesla stock, and the stories are a little bit different. The big story on the Meta side is the fact that we are talking about the current, at this moment, support level, cash flows, and lowered guidance versus Tesla, where the margins and their costs are changing. That's a very big different story at the current price. So two fascinating things to take a look at in all of these things. Let's see, Danielle, good morning. Wolfspeed chipmaker and technology. Wolfspeed chipmaker and tech. Oh, okay. All right. Thank you. Hey, Danielle, by the way, thank you for being here. Really appreciate that. So anyway, I want to jump into one other thing that I just promised. There's three groups. So if you remember what we do every day, let me just pull this up really quick. When we're doing the market analysis, we do what we call a stock market power pyramid. We look at the three major, the big three, we call them the three majors. Then you go up to sectors. What I'm talking about right now is industry groups, because basic materials as a sector has started to get strong. But within this group of industries, there's three that we're leaning on right now. And I'm just going to pull this into the sheet so everybody has an idea. Industrial stocks as a sector. That's one thing that we're looking at. So we've actually been watching Boeing and Caterpillar and Raytheon. These are the three ones that we've mostly been focusing on right now. So if we pull up those stocks, just give you a little, and this is not basic materials, this is industrials. So Caterpillar, you can see the kind of day that Caterpillar had on Friday. So it's getting interesting again. Boeing, nice little slow grinding, higher lows, higher highs with some room to go. And Raytheon kind of coming off the mat as well. So they are not fully confirmed as order flow. They're mostly weekly order flow is how it starts. But something else that's super interesting, and I'm going to pull this back into the screen so you can keep an eye on it and maybe do a little bit of research on your own right now. Copper, steel, and silver industry groups are starting to wake up right now. And if we take a little bit of a further look at some of these stocks, you can see that they are actually breaking out right now. So keep an eye on these three groups of stocks and do a little bit of diligence. These are industry groups to research. So that's what we're actually going to be talking about the rest of the week, is these groups of stocks and paying attention to them. So to recap the week, a a lot of earnings this week. You got Amazon, Google, Meta, big stories this week. You have GDP this week as well. There's a perfect firestorm of activity going on this week. So let's kind of wrap that up in a nice little bow. Technology stocks, specifically NVIDIA, AMD, Micron, TSM, they are more in bearish order flow right now, and they've kind of gone sideways for multiple weeks right now. After this, let me actually go to AMD. After that big announcement where they pre-announced over here and actually got pummeled, but now it's kind of still sideways. It hasn't followed through to the downside. So right now in this group of stocks, most of them are kind of sideways. So I'm just going to read the tape here. I am bearish to neutral on those stocks right now. So anything short term as maybe a 1 to 2 day trade, if it's to the upside, I'll have a little bit less position size. If they break to the downside, it's in the direction of that order flow. So I'm going to actually look to short those. So maybe Danielle has a little bit more depth on this that we should take a look at. So thank you for that, Danielle. As far as the other side of the market, the bullish side of the market, energy stocks continue to remain well bid. Quite a few of them had some big breakouts last week, and we are still looking for them to follow through. Now, the challenge here on these is some of them are still at breakout levels. Some of them have already gone too far. So you really need to set up what we call your average true move in these stocks, in the energy stocks, in order to determine if you're about to hit that buy button, am I buying too late in the move, or am I doing it where it's just taking off? So again, I'm going to pull up the list of sector rotation, and you can actually see what we're keeping an eye on this week. Let me actually make that a little bit bigger so it's easy to read. So you can see there are a couple of sectors. So remember what we do. We're not in the business of predicting. We're in the business of paying attention. And the more we pay attention, our job is to say, where does smart money have attention right now? They have all of that research, all of those people, all those analysts, and then they have money to do something. So in all of that combined, we should be like sitting up in our seats and saying, yeah, hey, they spent all that money. They have all those research people. Let's see what they're doing. And that's how sector rotation turns into some really high probability trades. Now, stacking the order flow is how long has that attention been on those groups. So if we hop on over and we keep an eye on these guys, energy is strong across the board. Basic materials, strong across the board. And we just gave you the breakdown of basic materials. It's not all of them, but you can see that some of them have actually been breaking out in a big way. We also have industrials. Now, the kind of sneaky one that I want to give everybody is actually one that's at the bottom of the list here from last week, which is healthcare. Healthcare, you want to do a little deep dive in whatever software you happen to use. You dive into healthcare right now, and you're going to start to see that healthcare stocks are starting to what we call catch a bid. Now, it just kind of makes sense. If we're in a recessionary period, there's certain things that we need no matter what. No matter how price goes up on that, we need them no matter what. So I'm going to give you a little bit of research this week. Look up healthcare sector and then do a little bit deeper dive into stocks in the healthcare sector. I think you're going to be pleasantly surprised that there's some stocks actually breaking out. And one that we've been talking about for a while now that's been in the list, which finally broke out last week, which was Cardinal Health. And you can see that it's actually been kind of stuck in this window for a while. So there's a lot going on right now. And actually, Franz is saying Tesla has difficulty to sell their cars in China, cheap cars in China. So yeah, that's exactly what I mean. There's competition comes in and your margins change all of a sudden, and that changes the math for the company, right? All right, everybody, we're going to head out. Have an awesome day. Remember the breakdown that we just did. Semiconductor stocks kind of bearish to neutral. Watching Meta earnings this week. Amazon and Google coming out this week. Healthcare stocks kind of sneaky right now. Pockets of opportunity in basic materials. Copper, steel, and aluminum. Let's take one last look at Alcoa right here. And just to give you an idea, it's right on the cusp again after 2 big days and flat. So Alcoa has some room to go up to 54, which is a pretty decent move to the upside too. So I'm jazzed up for the week. We have big economic numbers this week. We have a ton of earnings this week. Learn to read the tape this week because this is going to be an amazing, amazing week of volatility. I'll see you on. Have a great day, everybody.